Welcome back to Mid-Cap Radar. Well, one pocket of the market that's done very well over the past 6 months has been the auto space. Quite a lot of disruption coming in over there, especially in the two-wheeler, three-wheeler space. So let's put the spotlight on the auto sector. Amyn Pirani, the head India Automobiles and Transportation Research from JPMorgan, joins in from the JPMorgan India Investor Summit. Good afternoon, Amyn. Thank you so much for joining us. First up, give us a sense of how exactly are you looking at the four-wheeler market in India. There appears to be a little bit of moderation in PV demand, but how are you looking at on-ground trends?
Sure. Thank you, and good afternoon, and thank you for having me on the show. As far as passenger vehicle and four-wheeler demand is concerned, I think one thing we need to remember is that unlike other categories, the passenger vehicle sector was already 20-25% higher than pre-COVID levels as of fiscal year 24. So given that base, it was expected that some kind of moderation would be there. YTD, if I look at the trends, we are growing at low to mid-single digits. The start to the festive season is looking good, and there's an expectation that in the month of October and possibly the first half of November, we could see very strong growth on the base of last year's festive, which was also a good number. But at the same time, we need to remember that the growth rates that we saw in the last 2 to 3 years, they have to be moderated a bit. And there are some other categories within autos which could actually outperform.
And what would that other categories be, Amyn? Anything in particular? Would it be two-wheelers or the CV cycle that's turning for the better now?
Yeah. So two-wheelers is a space where, we have been, quite bullish for a while now. Two-wheelers was the last category to start recovering. The main cyclical recovery started in two-wheelers during the second half of the last financial year. And we do expect that given that two-wheelers are still below pre-COVID levels, it is likely that over the next few quarters as well, two-wheelers could continue to outperform passenger vehicles. Commercial vehicle is somewhere in the middle. We reached pre-COVID levels sometime last year. Since then, it has been, a bit of a stagnation. But as we start getting into 3Q and 4Q, it is likely that we will start to see some a good base. And on that base, we could start to see some growth. We also need to remember that on commercial vehicles, OEMs have also decided to reduce discounting, focus on sustainable, profitable growth, and hence the volume growth needs to be viewed in that context.
Okay. So we will see growth, but maybe in some of the categories it will be lower than last year. I know you wouldn't talk individual stocks, and I'm not even asking for that. But, recently we had the comment coming in from Rajiv Bajaj that Bajaj Auto stock could touch that 20,000 mark. It was on CNBC-TV18 that he said that. I see that's an overweight for you. Is this something which is working out for the two-wheeler industry overall, something that you can talk about specifically on what could the future triggers be going forward?
See, if you look at the two-wheeler sector, like I said, post-COVID, that segment was slow to grow, and hence valuations across two-wheeler companies were trending on the lower side vis-a-vis other subsegments. But if you go back, pre-COVID levels, if you look at any 5, 10, 15-year horizon, two-wheeler growth has actually been in line and in some cases slightly better than passenger vehicles. So from that point of view, I think if you look at two-wheeler companies, there is no reason why valuations for them should be at a discount. And what we have seen in auto sector, for the last, several years is that if a category is growing faster than other categories, and within that, if companies are growing faster than their peers within that category, so any company which shows market share gain ends up seeing a valuation re-rating, and companies which are losing market share on a relative basis see a valuation de-rating. And two-wheelers as a space, is in a sweet spot right now.
Got that, Amyn. Moving on, a couple of questions. Number one, how are you looking at, both Indian auto companies as well as some of the auto ancillary companies that are export-facing? So names like, Tata Motors or Motherson Sumi, Bharat Forge, you may not be able to comment. Outside, you have seen quite a lot of guidance cuts come by as far as OEMs are concerned. So are the volumes for these companies, this business for these companies at risk?
Sure. I think we need to deconstruct the guidance cuts which have come from the global automotive companies, like you mentioned. A part of that is actually the slowdown in China. And when I look at companies, at least in the auto component space, the exposure to Europe and US is generally higher than it is to China. It's not that China is not important, but the exposure is relatively lower. The second thing is that, if you look at the details of the guidance cuts from a lot of these global OEMs, in a lot of cases, it is to do with supply challenges because some supplier is having some issues or because there are some recalls in some specific parts. And hence, while this may lead to short-term disruption for the Indian auto component companies, I do not see that, as a big challenge over a 3 to 4 quarter period. Lastly, what I would like to add is that most large automotive component companies in India have started diversifying into non-automotive and industrial areas like aerospace and defense, which are new categories for them. They increase the addressable market. And hence, if you put all of this together, yes, compared to last year, the kind of growth that we saw, we might see some revenue growth moderation. But because the cuts itself are specific to certain reasons, plus because of the non-auto additions that a lot of these companies are doing, I think over a 3 to 4 quarter period, we do not see much risk to expectations.
Okay, so what are we expecting? The non-auto side of business that they're expanding, by when will that start showing in the books? Until then, will we continue to see some impact on margins? Generally, I'm asking, once they add this new portfolio, what happens to margins?
Sure. So again, generally speaking, aerospace, defense, and all these non-automotive areas, margins tend to be equal or slightly better for most of these companies. And hence, we are not expecting this diversification to be margin dilutive. But I think the larger point is that as your revenue base becomes more and more diversified, the cyclicality or the volatility on your revenue growth and your earnings comes down. And then over a period of time, the valuation starts to re-rate because the business is not as cyclical as it used to be. For some of the companies within the automotive component space, the non-auto bit is now as high as 30-40%. For some other companies, it is less than 10%. But over the next, say, 2 to 3 years, we expect this number to go up higher for most of these companies.
I mean, one more question from our side. What we want to understand is, as far as Q1 was concerned, on the back of much higher volumes and also lower steel prices, you actually saw operating leverage kick in, and a lot of the companies, especially two-wheeler names, saw record high EBITDA levels. Can this trend sustain Q2 onwards and for the rest of FY25?
I think as far as 2Q is concerned, commodities still continue to be relatively benign. I think they are still being supportive. And we'll have to see, how it plays out over the remainder of the year. But for now, commodities seem quite benign. The other part is that while two-wheelers have been slow to recover post-COVID, in fact, if you look at the last several quarter margin performance of all these companies, they have actually been inching up. So what we've seen in the two-wheeler space is, slow but steady price hikes to offset inflation. And a discipline as far as that is concerned. And because demand continues to be quite strong, finance availability has continued to improve. These companies have not been in a situation where they have to, give higher incentives or higher discounts. And hence, I do believe that margins across these companies can continue to remain at these levels. And if commodities continue to be supportive in second half and in fiscal 26, then maybe there is a possibility of some improvement as well.
Okay. Amyn, last question before we let go of this interesting conversation. You track the tire space as well. How is that space looking like right now, considering the commodity prices and the scenario that we're in, and that shift that's happening to EV? Does that improve the profile overall for these players?
Okay, so I'll try and answer, in two parts. First of all, yes, we have seen that in the last 2 quarters, especially commodities have moved up quite sharply. Rubber, even synthetic rubber, natural rubber, most of the commodities have moved higher. And what happens in the tire segment, especially on the replacement side, which is the larger part of the revenue base, price hikes happen gradually. So what we are seeing right now in the market is that commodities from the peak have started to moderate down slightly. We are starting to see some decline. Price hikes are happening, but they have not yet caught up. I think the September quarter could also continue to see some pressures. But starting December quarter and March quarter, assuming that commodities don't go up again, price hikes could start to catch up, and we could start to see margin recovery again in the tire sector. I think as far as EVs are concerned, the interesting thing is that unlike a lot of automotive component segments, which are dependent on engines, tires is actually agnostic. So actually whether EV share goes up or not, you will continue to need tires. In fact, since EVs are heavier and they need less rolling resistance, more fuel efficiency because of the weight, tire companies have an opportunity to upgrade and improve the mix going forward. So EVs at worst is a non-event for tires. In a best case scenario, it can be a ways of improving mix and improving margins over a period of time.
No, that's exactly what I meant to ask. Will it improve margins for them? Because most of these companies have been quite bullish on the EV opportunity. Of course, the demand for tires won't go away. Maybe the realization per kit could. So that's what exactly I wanted to understand. Thank you so much for joining in today with all those insights and your take on the auto space. That's the word coming in from JPMorgan. That's their auto call. But for now, we'll slip into a short break. When we come back, we'll get you more on the markets and also talk about Skipper. It is buzzing in trade. That's our mid-cap spotlight. Stay tuned.